me a
Sure,
test
sure, whatever you'd
question?
like. Yeah. So you want to do it with the slides or want to do a whiteboard? How would you like to do
Yeah,
it?
slides. I like your slides a lot.
Okay. Let's find that. And I basically tell people, you know, the lecture I have on YouTube is don't overdose on margin. I had a Merrill Lynch guy. He does, he put in the work, and I think he deserves to get his questions answered. But he kept calling me with these obtuse margin questions, and I said I don't mind answering them. I just feel bad that this time would be better spent somewhere else. I had a young lady whose their firm was using Past Perfect, and they won't let her move on. And I felt bad because she's spending $225 an hour having me help her with questions she's never going to encounter on the actual exam. But
Right.
a margin account uses leverage. It allows you to use some cash, some credit to purchase securities. Margin is money required for the transaction. Now, I think we had a one where you struggled a little bit as I recall, because we had a situation where we bought 300 shares of the stock, and then we bought the options, and you were being required to recognize that you can't buy options on margin. If you're
Yes.
going to buy an option, you got to pay for it, right? Now, they're not going to test you on what you can buy on margin. What is testable is what you can't buy on margin. So what you can't buy on margin, the two big ones are new issues and option contracts, right? So if you want to buy new, you say, hey, Dean, this company went public a while back. I missed getting an IPO allocation. I'd like to buy it in the secondary market. I'd like to do it in my margin account. I said, Brian, how long ago did it go public? You say, does it matter? I say, it does. You say 2 weeks ago. I say, you got to pay in cash. You say
Is it?
6 weeks ago. I go, no problem.
Got it.
All right.
So
So
new
very
issue
testable.
inside 30 days.
That yeah, inside 30 days. So be careful on this, the open-end mutual fund. It's not a different rule, it's the same rule. Every member share in an open-end mutual fund is a new share. And I just told you we can't lend you money by new shares. Now, what we're trying to say here, though, if you've had that mutual fund fully paid for 30 days, then you can use it as collateral.
Okay.
Right. So my previous example, you say, Dean, it went public 2 weeks ago. I say, okay, we do it in your cash account. 3 weeks later, you say, can I put it in my margin borrow against it? Absolutely. Right.
Right.
So once it's 30 days. Now the documentation is very testable. So to open a margin account, you need a credit agreement. That's where you say you understand you're borrowing money and you're paying interest. The hypothecation agreement, that's where, again, mandatory. You say you understand that you're pledging your securities as the collateral for this loan. I say, Brian, we have other customers who wish to establish short positions. Would it be okay if I lend them your securities? He said,
That's
well, I don't
optional.
think it's in my best interest to help people establish short positions. I said, Brian, it's not. And that's why this part of the documentation is optional,
Okay.
right? Do that. So Reg T is 50%. If the Federal Reserve wanted to, could say 60. I think we ran into this situation yesterday where we were buying stock and got asked, how would you pay in stock instead of cash? And you would have to deposit stock with loan value. So in our example, the margin call I made up was $20,000. And you were saying, "Oh, I want to give you cat stock instead." I said, "Okay, you got to meet 200% of that, or stock equal to whatever that loan is," which in the case was 20,000. It ended up being 200% of the cash call. I don't think you're going to end up with any questions about Reg U. Reg U is this rehypothecation. I don't think you're going to see that. This is very testable. I can't imagine on Tuesday you're not going to get asked about this scenario. So there's three versions of this on Tuesday. And this is a FINRA rule about having a minimum of $2,000 when you open a margin account. The first version of this is somebody buys less than 2,000, in which case they pay in full. The second version of this trick is between 2 grand and 4 grand, they pay two. The last version of this trick is there is no trick and they pay half. So let's have you demonstrate your prowess. So boom, we buy 100 shares at 15. Do you give me half of that? Do you give me two, or do you pay it in full?
Painful.
Right, a second version of the trick. You buy 100 shares at 30. You say, Dean, I know how margin accounts work. I'll send you 50%, 1,500. I say, Brian, if you had an established account with me, that would be correct. But in a new account, that's a very important phraseology on Tuesday. New account, initial transaction, you need to come up with 2. So between 2 and 4, you come up with 2.
Mm-hmm.
You say, hey, Dean, I know how these new accounts work. I'm going to buy 100 shares at 50, and I know I need 2 grand. I said, well, Brian, no, half of 5 is 2,500. You need to send me 2,500. All of those versions of that are testable. I don't think you'll get all 3, but you're going to get a version of that question.
So just to translate, if it's under
Under
if
2, you pay in
if it's
full.
under 2, it's full. If it's over hold on,
Between
go back.
2 grand and 4 grand.
Yeah, it's 2.
2 and over 4, and then there's no trick in play.
Okay.
Right? And that is very, very testable. Boom. So here we go with the initial setup. I call this the initial setup. So the customer says, Dean, I want to buy 1,000 shares at 40. I say, Brian, do you want to do this in your cash account? Do you want to pay in full? Or do you want to do this in your margin account? You say, Dean, I'd like to do it in my margin account. I said, well, Reg T says that you initially, Brian, have to be at risk for 50%. So I need $20,000 from you, and we will loan you $20,000. The margin call is $20,000. When is that margin call due?
I mean, the margin call is due when
So
the
I need this
stock goes
20 grand
below.
from you. And when do I need that 20 grand?
But sorry, are you asking in a scenario like if the
I'm asking if a customer has a margin call, how many days do customers have to come up with monies or securities?
Oh, is it 2 days?
T plus 2 is between broker dealers. Under Reg T, Brian, test point, clients get 2 additional days.
Right.
So
Okay.
you have T plus 2 plus 2. Brian, where's your 20,000? Now,
Right.
if you're a customer in good standing, I could get you a couple extensions, but I can sell you out after T plus 2 plus 2. If you don't pay for the stock, I'm going to sell you out.
Okay.
Now, if I sell you out and there's a profit, let's say by the time T plus 2 comes, I sell you out and this is a $40 stock and now it's a $50 stock. There's a $10,000 profit. Do I have to send you that profit?
No.
I do, but then I say, Brian, you free rider, you took a free ride. You bought and sold the stock without paying for the buy. You use broker dealer money, not your own money. I'm going to send you that 10, but I'm going to freeze your account test question for 90 days.
If you
For
free
90
ride.
days, you have no credit privileges. Be careful. I'll still trade with you. What's frozen is your ability to use margin. So moving forward, you want 1,000 shares at 40. I'm going to want 40 grand in the account before I do it. So that's
And you
called a
get frozen for what? For free riding? What else?
Yeah, for a free ride. That's what you did, right? A free ride is when you didn't pay for it, right? You bought it, you sold it, you didn't pay for the buy. I think it was like kind of kiting a check. I had the head margin clerk told me that at Schwab, that Schwab they give customers 3 free rides before they shut them down because they think it might be something they're just accidentally doing. And I said, his name is Brian. I said, boy, you would never want your customers to know that because if I know you're
Exactly.
internal, I get 3. I'm like, okay, I
Yeah.
got 2 more, before they shut
Take
me down,
advantage of it.
so. I love my brother, but he was talking about his bank, being on top of him. I'm like, oh, Chris, I'd be on top of you too. I mean, he was kind of complaining that they're not on top of me. I said, well, Chris, they're not on top of me because I'm a good customer and it doesn't look like I'm up to any shenanigans, so.
Yeah, exactly.
So excess equity. Okay, so, you're going to make money twice as fast, but you're also going to lose money twice as fast. So what you're hoping is the stock going to go up, and I'm going to show you what happens when the stock goes up. What we're going to do now that we've done our initial setup is what's called a mark to market. Every day is a new day. And so now I'm going to show you the stock going up. Boom. So here we go. So now the stock goes to 50. And I call you and I say, hey, Brian, looking pretty good, my friend. You bought 1,000 shares at 40. You made the required deposit. Right now, the stock is worth 50. If you sold the stock and paid off your loan, I'm not suggesting you do so. But equity represents what you would have if you did so. I think the best analogy is a house. Market of the house, market value of the house minus mortgage on the house equals equity on the house. I said, hey, Brian, I'm allowed to lend you up to 50% of the market value. The Federal Reserve Board says you only need to be at risk for half. You're at risk for $30,000. And you only need to be at risk for 25,000, half of the market value. You have $5,000 in excess equity. You say, well, Dean, when I have excess equity in my house, they'll lend me some money. They'll give me an excess equity line of credit. I said, Brian, we're willing to do the same thing. So right now you can have $5,000 in cash, or you could buy $10,000 worth of securities.
Well, hold on.
Do I have to do anything today? I said,
So
well, fine. Yeah.
Sorry to interrupt. So I understand kind of where you're going this. So look, if I look at the left, just to talk this out loud, so it went up by 10 grand to 50. And I do this chart. I'm sure you've seen that Notman teaches you.
Yeah, I think it's a balance sheet, right? Isn't it like the house, the balance sheet thing?
The square, right?
Yeah,
So,
yeah. It's Marcia Burek who works with others. I've known her for years.
yeah. So like, if I'm just doing like, I'm a visual guy.
So in her
so
chart, Marcia's chart, the 50 is your asset, your 20 is the liability, and the equity is that little box on the side, right?
Right. So, but I'm just, sorry. So you're saying 50,000, right? It's long market value.
Yeah.
And you always, just to talk this out loud, the Reg T is always 50% of the long market value.
Yeah,
right?
I'm just comparing that because I love lending you money. So I'm always going to compare what you have to Reg T to see if perhaps I can't loan you more money, because one of our all-time favorite things to do. So
it wasn't my equity, my original equity was obviously 20.
Yeah, by the way, let's just stop there. If you bought a house, right? So bought a house, it'd be the same thing. So here, had you done this in your cash account, gave me 40 grand, stocks at 50, you would have made 10 as well, but you would have put up 40 to make the 10. Now you put up 20 to make the 10. You're making money, what is that, 50%? You're making money twice as fast.
Mm-hmm.
So you're making, it's called leverage, right? That's financial speed. Now,
Right.
what I'm going to tell you though, is you say, well, Dean, 40, I like it at 40, but 50 is a little rich for me. Do I have to do anything today? I go, no, Brian, I'll tell you what I'm going to do. I'm going to make a special memorandum to your account that on today you had $5,000 more than you needed. That way you won't lose access to this. If I didn't do that, you might use this in a way that's not in your best interest. Now, I usually tell people, Brian, I don't think on the test it would do you any harm to think of the excess equity and SMA as one and the same. Now you say, Dean, I like it at 40. I like it at 40, but 50 is a little rich for me. I say, okay, well, you don't have to do anything if you don't want to. The stock goes back to 40. And I call you. I say, Brian, you told me you liked it at 40 and it's back at 40. The market value is now $40,000. You still owe the brokerage from $20,000. You have $20,000 in equity. Reg T is half of that. You have no excess equity. You say, damn, I would like to buy more at 40, but I don't have any excess equity. I say, aren't you glad, Brian? I made a special memorandum to your account. You still have access to that line of credit. You can still have $5,000 in cash, or you could buy $10,000 worth of securities. My favorite would be buying securities. So that's the whole point of creating that holding tank for the SMA. Now, the only way you get your own money out of this account is to sell securities. So if I send you $5,000 in cash, you now owe the broker to your $25,000. The 20 I originally lent you and the 5 I sent to you. So, it's borrowing. And if you buy $10,000 worth of securities, the long market value goes to 50. And now you owe us 30,000. The 20 we originally lent you and the 10 we're lending you now.
Okay.
The only way you get your own money out of this is to sell securities. So what would be our favorite? What would be our favorite? That you ask for cash or you buy some more stock? What would the broker prefer you do?
Wouldn't you want to just buy more stock?
Yeah, then I get the commission, I get the additional financing charge.
Right.
Yeah, right. So here we go. You say, Dean, let's buy $10,000 more. Right? So this is what the account will look like before we buy the stock, buy some more stock. Boom. That's what it looks like. And now we're going to buy some more stock. So now you owe us, you have $50,000 in market value. We're loaning you another 10 on T plus 2. We didn't use any of your money. We used broker-dealer money. So now you owe us $30,000. The 20 we originally lent you, and the 10 we're lending you now. You had 20,000 equity, you still have 20,000 in equity. Half of the 50. Damn, Brian. Can't loan you no more money, my friend. You don't have any excess now. You use it, you lose it, you're now below 50%. When you are below 50%, Brian, which you are now, that's called restricted. When you're below 50% on a margin account, it is restricted. I'm not going to bother you. You're not always calling and say, hey, Brian, you're restricted. You would only find out you're restricted, Brian, below 50% if you sold securities. As a margin clerk, I still wouldn't tell you restricted. If you sell securities, you owe us money, I'm going to pay down your loan. That's what I do. You'd only know you're restricted if you say, Dean, sell securities and send me a check. I said, well, Brian, did I tell you you're restricted? You go, you never mentioned. I said, well, it didn't matter till just now. When you are below 50%, Brian, you sell securities, you can only have half the proceeds. What do you got to do with the other half? Pay down the loan. We're not going to let you go any deeper is the point. So that's what's restricted. So here's a little overview of when the customer is restricted below 50%. So restricted accounts, you can see the title of my slide. The restriction is you can only have 50% of the proceeds. When equity is less than 50%, you're buying more securities, you got to put up half. If selling securities, there's the restriction. The restriction is you can only have half the proceeds. If you leave it all in there, we pay down the loan. So if I'm a margin clerk, you owe the money to the broker dealer, we pay down the loan. Now, if you didn't know that, you say, hey, Dean, I wasn't going to ask for a check, but now that you bring it up, you're telling me that if I don't ask for a check, I only get half. I kind of, maybe I should take the half now. I said, well, no, Brian, I prefer as a margin clerk, you leave the money in the account. If you're worried that you won't be able to get the half later, no worries. I'll tell you what I'm going to do, Brian. You sold $10,000 worth of securities. I'm going to credit your SMA for the half you could have gotten and chose not to. It's a neat trick. I'm trading you real money for fake money. And I'll pay down your loan. That's the only time as a margin clerk that I'm making direct entry into an SMA that isn't a function of mark to market. Here's an example of that.
Can you say that last part again? I didn't understand.
So here we go. I'm going to show it to you. I'm going to illustrate it to you. So let's first look at this account. And we just said that this account is now restricted. We said this account is restricted because it has less than what? 50%.
Less than 50%.
Yeah. Now, if you wanted to move the restriction, you could send me $5,000. I'd pay down your loan, boom, and the restriction would go poof. But that's what this account is right now. And I say at the top here that you sell $5,000 worth of securities. If you sell $5,000 worth of securities,
50% goes to pay it down.
well, yeah, if you don't say anything, I'm going to use the entire proceeds to pay down your loan. But if you say you want the check, I say, sorry, you can only have what? Half. So we know that when we sell $5,000 worth of securities, the market value is going from 50 to 45.
You're still short by 25.
Well, and here's the point now. We're going to take all the money. If I'm a margin clerk, you owe the firm money. All money coming into your account pays down the loan. So I'm going to pay down the loan to the broker dealer to 25. You have equity at 20. Half of that's 22.5. It looks like you don't have SMA, but remember what I told you I would do for you if you left your money in the account? I told you I would credit you for the half that you could have got and chose not to. So I'm going to put $2,500 there so you can circle back and get it later. So that's the most trickiest thing. I don't think you're going to see it Tuesday. I only have
understand that because, sorry.
Yeah.
because you had 5,000 in SMA, right?
We used our SMA. You use it, you lose it.
Right.
If
So how
you
do you get,
use it, you lose it. We had $5,000 in SMA that we used as buying power.
right? And that's how you got the 10 grand in stock.
Yeah, that's what put us into restriction.
Why did you get a 2,500 credit back to the SMA? I just that last part.
Because again, if you say you'll leave all the money in the account, if you right now you could have $2,500 if you wanted. So there's two scenarios. Either you take 2,500, half the proceeds, which you're entitled to, and now you owe us 27.5 because we're going to take half to pay down the loan. I would prefer, Brian, that you take the entire 5 grand and pay down the loan. So I'm telling you, Brian, you can either have half of that 5 grand today. And if you do take half of the 5 grand today, you're going to owe us 27.5 because we're going to only have $2,500 to pay down your loan. I would prefer, Brian, that you put all of the 5 grand against what you owe the broker dealer. And you say, well, gee, that I can't get the 5 grand later. Half of the 5 grand later. I go, you can't. If you will leave the entire $5,000 in your account, I will credit your SMA for the half you could have got and chose not to. Your SMA is your line of credit. So it doesn't look like here you have a line of credit. That's the trick. It's more of a vendor trick than it is a, Tuesday trick.
Do you
But
think
the
it's
trick here is you
testable?
would tell me that this customer has no SMA. And this customer has $2,500 in SMA because this is the one time and the one time only that the SMA is not a function of mark to market. It's a function of you could have got half of the proceeds and you did not. And so we're going to say, why don't you leave it in the account? Like trading you a credit line. Again, I don't think you're going to see it, but what we're telling you here is if you will leave 100% of the proceeds in your account, we will pay down the loan.
Right. Okay.
That's what that's about.
Okay. I think I understand that, but I don't know.
Yeah, well, it's and I don't think you need to understand it to pass the test, which is the point. You definitely know maintenance. And you need it, but the house requirements can always be more stringent. They just can't be more lenient. So you need to know long account is 25% and a short account is 30%. Now, in our example, Brian.
And these are all Reg T rules for maintenance?
No. Reg T is only to get going. These are New York Stock Exchange FINRA minimum maintenance.
FINRA.
And
Okay.
our house requirements can always be more stringent. I don't know of any firm that doesn't have minimum maintenance numbers that are much higher than this. But that makes sense, right? As a casino, I could say, Brian, your play is a little too strong for us. We'd like you to take your action elsewhere. Or, Brian, the gaming commission says you simply can't do this. There's nowhere in the strip you can do what you want to do. So it's important I can articulate to a client when he's running afoul of, house rules, because he wants to change a house, or when he's running afoul of New York Stock Exchange or Federal Reserve Board rules. All right, now be careful on what you're being asked on Tuesday. Now, in our example, you had a $40,000 account. We lent you 20, you had 20,000 in equity. And you say, Dean, how far down could my account go before I would have a problem? I said, well, Brian, right now, 25% of 40 is 10. You got 20, not a problem. You said, Dean, I didn't ask you what maintenance on my account today is.
Is this the over 0.75? So
That's right. I say, Brian, why are you sending out negative vibes like that? I
so
said,
this
we
is
figured
long
out. I
market
say,
over
Brian, that was on my Series 7. And so you owe the brokerage firm $20,000. We're going to take the $20,000 that you owe my brokerage firm. We're going to divide that by 0.75. And that gives us market value at maintenance. And that's very testable. So if this stock goes below 26,666, sign of the devil, you're going to have a problem. And again, I say, well, geez, Dean. So we know based on this formula, that's why it's kind of helpful. I know that if I mark you to market at 24, you got a problem.
So this is the debit balance, so this is not the long market value.
Yeah, this is long market value maintenance. So, yeah, we're taking the debit to find out. So I already know I'm going to do a mark now at $24 a share, 24,000. What's nice about this is we already know that there's a problem. And how do I know there's a problem? Because 24,000 is below what?
26.
Yeah, if I was looking at 30, there'd be no problem. So it's kind of a helpful thing as a margin. 30, no problem. 24, there's a problem. I say, Brian, you owe our brokerage firm $20,000. And we're only holding $24,000 in collateral. And he said, well, you never called that collateral before. I said, because I used to be your broker, but now I'm your banker. At all times to maintain your account. He said, well, Dean, it sounds like you're threatening me. I say, I'm not threatening you. At all times to maintain your account, you need 25% of the market value in equity. You need 25% of 24. By the way, we knew we were going to have a problem because we knew, right, that that's a problem because it's below that. I say you need $6,000. You need $6,000 and you only have what?
Four.
That's minimum maintenance. You got 4. So what do you need to send me?
$2,000.
Yeah, 2,000,
Yeah.
and I pay down the 20, right? 20 goes to 18. You're at 6, and I call you again tomorrow. Test question. When do I need that 2,000 from you?
You just said tomorrow, but is it
It's promptly.
say again?
Promptly. We'll never tell you what promptly is because we don't want to say, Brian, sorry, that wasn't prompt enough. Right?
So when is it due on a maintenance?
Promptly. I'm not going to move on that because I'm going to sell you out and I'm going to say, sorry, that wasn't prompt enough.
Okay.
You say end of the day, I go promptly. You say tomorrow,
Okay.
promptly. I've said the guy who was tutoring on 24, and he got a call. I said, "Do you want me to step out of the office?" He said, "No, you can stick around while I take the call." And you could tell it was a margin call. He said, "I thought he was being nice because he kept saying promptly." And then finally he moved off it. And I thought he was being nice. He said, "Brian, let me put it another way. Maybe this will make it easier for you. If it's here by market close, you got no problem." And I
Right.
couldn't hear the other side of the conversation. The guy keeps talking. He goes, let me say it another way. We'll just keep going at it till you get it. If it's not here by market close, you got a problem. I thought that was kind of nice of him to move off
Yeah.
promptly. Now listen, there may be 50 ways to leave a lover, but there's only 3 ways to take care of this. Cash. You tell me you don't have any cash. I say, well, do you have additional collateral? You say, I got a Rolex. I go, nope. You say, I got a new issue. A new issue? Oh, that's a little interesting. How long have you had it? Why am I asking how long have you had it?
Because it's got to be past
30 days, right?
30 days.
You have additional collateral. You say, I have a deep in the money option contract. No.
Can't pledge margin or can't pledge options.
And I say, sorry, if you can't come up with the cash, the additional collateral, then we're going to liquidate securities.
Right.
We're going to sell you out. Okay, so we have 2 types of margin accounts. Whether you want to borrow money or borrow securities, you need a margin account. And so the other type of position we have at brokerage firms are short accounts. Right? There's our classical equation short. This is where most people get hung up. They get hung up on where does the 48,000 come from? You say, Dean, I'd like to borrow 1,000 shares. I said, Brian, where you want to borrow money or stock from our brokerage firm, you need a margin account. Let me call Stock Loan and see if we can find you 1,000 shares to borrow. I say, Brian, good news. We were able to borrow the stock. You told me to sell it short. You got 32,000 from selling the stock you don't own. You need to put up 16, Reg T. So you're going to have $48,000 in the account. 32,000 from selling the stock you didn't own. And what you owe now, 16,000 from half. What you owe are securities presently valued at 32. So in a short account, you don't owe money, you owe securities. It is much, much more dangerous to owe securities. Right.
Hold on,
So
Dean,
here's an
Dean,
example of a setup.
Sorry, one question. So just so I'm thinking about this right. The Reg T 50%, That's 50% of
initially. In all
the
margin
SM,
positions, the customer must initially be at risk for 50%.
and the equity is the difference between the SMB and the Reg T.
Yeah, well, the equity in this case is the difference between the cash in your account minus the securities you owe equals your equity. So we went in the market, bought back the borrowed securities, gave them back to the person we borrowed them from. There'd be $16,000 left over. What do you want the stock to do? Go up or go down?
Go down, but I'm just trying to do the box, the same thing that they do on this.
Okay, well, here we go. So let's go over here. The asset on your box, the asset is the cash, right? And the thing you owe are the securities. So on the liability side goes 40. And then your box, they give you a nopping. The equity is the difference. It's the 20. And this is day one, so you're perfectly balanced. You 50% of 40, right? We want the stock to go down. So are we happy or sad if the stock goes from 40 to 30?
Happy, obviously.
Well, I say, Brian, we still have $60,000 in cash in your account. Yeah, I know people get hung up on this all the time. Let me remind you where that came from, Brian. You sold short 1,000 shares at 40, and we got 40 grand from that. I made you put up Reg T 20, that's the 60. If we went in the open market right now, bought back the borrowed stock, it would only cost us 30. In the balance sheet that Marcia Knopman uses, the asset is 60, but now the liability is only 30. So the net worth of our account went up to 30. We've made 10 grand from the stock going down.
Mm-hmm.
I'd like to be able to loan you either more securities, more cash. I'd like you to be able to use this excess equity. Right now, half of the market value is 15. Half of 30 is 15. That's all you need to be at risk, and you're at risk 30. You have 15,000 in excess equity. You can either have that as cash. What else can you do with that? Sell short additional securities. What would be my favorite? Sell short additional securities. Now, what are you afraid of in this short account?
Going the other way, but is that SMA the excess?
Yeah, that's right. The 15,000 the SMA and 2 times as the buy power. Hey, if it goes up, that's going to be bad.
Yeah.
What are 2 risk mitigation strategies? If you're worried about your short position, you sold short at 40, and you're worried about it moving against you, the opposite market direction, how might you mitigate this position?
You could buy a call.
Excellent. Good job. Buy a call. What else?
Or Bliss and slobs. You could buy you could sell stop.
Buy stop. Remember, you want to be able to buy
sorry,
buy
Bliss
stop
and
above
slobs.
the
So buy
slobs,
limit or sell
slobs
stop.
over bliss. Buy stop would be above the market. That's what you're worried about,
Yes,
right?
not slobs over Bliss. So you said sell
Hey,
stop.
listen though, as your tutor, I'm very pleased with that. That's
That
actually more.
was wrong.
Hey, listen, Brian, that's more important than what we're doing right now in terms of ledger entries, to be honest. To know the protected put or buy stop. All right, so now I'm going to mark you to market. You say, Dean, how far up could my account go before there would be a problem? And I said, well, I don't know what you're sending out negative vibes like that for, Brian. I mean, 30% of 40 is 12 and you got 20.
So
You say, Dean, I didn't ask
or
you what is maintenance. I asked how far up my account could go before there would be a problem.
isn't it credit divided by 1.3?
Yeah, excellent. Excellent. Right. Now, the reason that's helpful is because we know that if we mark this guy to market at 50, he's going to have a problem because 50 is above that number, right?
Yeah.
So we know that's a problem. So I say, listen, you need to have 15. You only got 10. I want 5 and I want it when.
Promptly.
Right on. Right on. All right. So there's a margin. There's an overview margin.
The one thing I missed in the short margin is I don't understand the credit balance at the beginning.
That's the most common thing people don't get. It's the cash that came from selling the stock you didn't own, plus the money you had to put with it. Let me just give you an example. Let's say
Like, why is it 32 plus 16?
Well, let me just share with you. So SeaWorld right now is a $50 stock price. And I am not a SeaWorld fan. I think it's really bad that they pin these workers up and make them do tricks. You know, I think these workers should be out raising their family. So I call my broker and I want to sell short 8,000 shares of SeaWorld. So there's a low K requirement. My broker says, Dean, we do have a customer who signed a loan consent form and we can sell short the SeaWorld. And so SeaWorld's $50. So I'm going to get $50,000 in cash from selling the stock I don't own. And then remember, Reg T is what I have to put with that. So now my broker says, Dean, you're going to get $50,000 from selling the stock you don't own. And Reg T says that you need to come up with half of that. So I'm going to have to come up with 25,000. That's going to be my Reg T requirement. And so there's going to be $75,000 in my brokerage account, 50 grand from selling the borrowed stock, then the half I had to put up. So this is what this looks like here. The classical margin equation, short. 75,000 is my credit register. Your question, where did the cash come from? It came from selling the stock I don't own, plus the half I had to put up. What I owe is not money. What I owe is 1,000 shares of SeaWorld, presently valued at $50 a share. So in a long margin account, you owe money. In a short margin account, you owe securities. You know, and what I'm hoping to do is sell high and buy low. And so that is going to be boom. And this is our classic margin equation short. And there's my 25 grand, just like in your house, right? When you put down a down payment, that's your initial equity in the house. And that equity may go up or down depending on what happens to the value of the asset. Yeah, that's Notman's little T thing they're sharing there with you. Their little balance sheet, boom. So what do I want the SeaWorld stock to do?
Yeah, go down.
Yeah, so maybe one of those whales takes a chomp at a train or two. That'd be good news, right?
Yeah.
That's what you get for, you know, messing with the orcas, right? I don't know.
Totally.
So the stock goes, let's say they close the parks and they're going to euthanize the orcas. And I say, geez, that wasn't what I wanted. But the stock goes to 30. So I still have $75,000 in cash in my account. And if I chose to, I could go in the open market, buy back the borrowed stock, give it back to the person I borrowed it from. I just told you it's a $30 stock. And so again, I'm going to be a happy camper here. Again, this represents what I owe, but what I owe in a short account are securities. I don't owe money. And so there, boom. Dean's a happy camper. I'm a happy camper because it's going my way. Please note, I now have $45,000 in equity. Equity always represents what I would have if I closed the account, paid back the borrowed securities loan. Nobody's suggesting I do that, but please note, if I choose to close this position right now, I've made $20,000 from selling the SeaWorld high and buying it back low. But that 75,000, again, your point, where did it come from? The 75 grand came from selling the borrowed stock, right? And then the Reg T requirement I had to put with it. Some text, I don't know if Notman does this, it drives me nuts. They describe this in a lot of vendors' materials as 150% of the market value, which I kind of think is kind of weird because it is 150% of the market value, but 100 from selling the borrowed stock and the 50 you had to put up with it.
Right.
So, all right,
Okay,
we're
got it.
past our hour, but that's not a problem. Is there anything else on your Sunday
There were-
Funday list?
Two other things, and maybe we can make these
Yep.
quick. Yield-based options, I know they're kind of funky because they go in the same, they're sort of opposite of what you think.
What's
So
the question again? I'm sorry, I missed you. The opposite?
yield-based options.
Yeah,
so-
I do think it's likely Tuesday you might get one. It's, you know, low probability, but yeah, direct relationship. So, you know what, let's just make our, again, we haven't spent, a whole 4-day class together, so I'm not quite sure where Knopfman differs from the way I set up things, but, here is what I call the options matrix. And then the way I set up the options matrix is I say, we got boom, we got boom, and we got boom, and we got boom, right? And so what we mean by saying that yield-based options have a direct relationship, and what we're trying to say there is that if you think interest rates are going up, you would buy a yield-based call. We spend all this time telling you that you should do the opposite. When interest rates go up, bond prices go down. But when interest rates go down, bond prices go up, right? There's a way to profit from that using yield-based options. So if I want to profit or hedge interest rates going up, I'd buy a yield-based call. There's no
So
way.
again, if you want to profit from interest rates going up,
Yep. What would I buy if I wanted to profit from interest rates going down?
a put.
A yield-based put, right? Because as the yields come down, it has intrinsic value. One other point, remember we said you may want to speculate on interest rates, but our players, we have speculators and we have hedgers.
Right.
So if you're a hedger, you have a bond portfolio, what are you afraid of?
Rates.
Going up or down?
Rates go up.
Yeah, so we buy a yield-based call. I say, Brian, to hedge our bond portfolio, I have some yield-based calls. And you say, oh, I thought we buy puts to protect things. I go, well, we usually do because usually there's an inverse relationship here, but in yield-based options, there's a direct relationship. So as the interest rates go up and our bonds go down in price, the value of our yield-based call goes up. And we're hoping we'll make up some money in that yield-based call that we're going to lose in the portfolio.
Right.
Right. So those are yield-based options. The question is recognizing the direct relationship.
Okay. And
then, by the way, same thing with foreign currencies. We should be predisposed to not want to do these two because remember, these have more risk.
Right.
So it's, almost always when we say hedge, we're going to buy the hedge and not sell the hedge because buying the hedge is the smarter way to proceed.
Okay. And then what about taxation on options?
For the most part, it follows a break even. Let me just go show that to you. Boom, boom, boom.
By the way, just bill me for an extra 30 minutes.
No, no worries, no worries.
No, I mean it. You're so generous with your time.
No, that's all right. Yeah, I think I did send Jenna. I don't keep credit card information, so I told her to send me your credit card for the sessions we just booked on the fly. I'm thinking
Okay.
you could be. I told you you're being a good beta for me in terms of my off grid. I'm not for you, not for you. But I'm thinking about adding an extra button, emergency tutoring session.
Yeah, I like it. Break
Where,
glass.
maybe it's like 300 or something, but I respond and it's like a firefighter or something.
Yeah, I like
I'm
it.
not sure that I want to do it because I like I like having my life. I already am struggling a little bit with all the people on the YouTube channel who think that all I do is sit around waiting for their calls. Anyways, here we go on taxation. Let me clean up my slide. So a good way to remember what can happen to options is with T. The option can be traded, the option can exercise, or the option can expire. And for the most part, taxation follows break even. Right? So here we go. So you're doing a closing sale. I'm going to show this to you in just a moment. If you did a closing sale, that means you originally did an opening purchase. If you did a closing purchase, that means you originally did an opening sale.
Yep.
And if the option expires, that's pretty straightforward. It's either good news or bad news. It's either a short-term gain or a short-term loss. But let me give you an example of this. So let's say that we bought one ABC May 30, call it 2. So that was our opening purchase. Is that money out or is that money in?
opening purchase money out.
Yeah, so that's 2. And then it says we did a closing sale at 3. Is that money out or money in?
Money in.
So now I say, Brian, we have $100 capital gain short term on your tax return. All options trading is short term. So this is our first version of a tax question. It's almost
Yeah,
a
leaps
camouflage
are like
profit
part
loss
2,
question.
right?
What's that?
Leaps are part 2.
Yeah, leaps are the only owning the leap. Could you qualify for a long-term capital gain? Because leaps are the only one you could be at risk for more than 12 months, right?
But this is not ordinary
Technically,
income, it's
leaps are
short-term
39
gain.
and practice 30. So the only long-term gain possible in trading an option is that you've owned a leap for more than 12 months, period, full stop. That's it.
Okay.
Everything else is short term. Even if you sell a leap and you're in the short position for over a year. All right. So you sold the 30, called 6. Money out or money in?
Money in. So it's a
Yeah,
net 1
opening
profit.
sale, right? You did your opening sale. And then you do a closing purchase at 8. So are you happy or sad?
You're sad.
Yeah, you got $200 short-term loss.
Yeah.
So if it's trading the option, it's just the gain or the loss. And the gain and loss is always going to be short term. Now we said the other thing that you could do is exercise. And for the most part, exercise follows break even.
Okay.
So, you'd be doing
I have
yourself a
one
great
more.
service.
Can you give me 30 seconds? I have to run. I'm dying. I
No,
gotta
no
run to
worries,
the
no
bathroom.
worries.
I
Yeah.
have one more question for you.
No,
Hold on.
no worries. Let me finish this one with you when you get back.
Sorry, I had to run
Okay,
upstairs.
no worries. So for the most part, Tuesday, you hear cost basis, just do break even. And you'll be right the vast majority of the time. So here's an example. We bought a 40, call it 3. We exercise. Our break even, our cost basis. So cost basis is 43. We sell the stock for 45, cost basis, break even, you have a 200 gain. The only time that's not going to be true, and I doubt whether I should even tell you this, is a covered call. On a covered call, my cost base is what I paid for the stock. And
Okay.
then my sales proceeds are going to be what I received for the option and the stock. So that's the only one that doesn't follow that. So
Go back
cost
to the other
basis
slide. What
follows
was the
break
other
even.
slide
What's that?
before this? The other slide. There was like
This
another
is where
slide.
I'm telling you that if you do the break even on
Oh, yeah.
Tuesday, you have the cost basis.
Got it. Okay.
All right. What else is on your list?
Last question. And this is sort of a hopefully not a loaded one, but back to the sort of matrix that I
Yeah.
put together that you approved.
Well, here's did you go through my version of the matrix? Did you see let me just find it for you. This is my version. That's a little, like I say, disconcerting because you're having different people, in your brain housing group telling you different things. But here's my version of the matrix in all its glory. Boom. Can you see that?
Yeah.
Right. Those are our 4 basic option positions.
Right. So is this? I mean, but I guess this is analogous to spreads, right? Because it's
Well, a spread. So your point, a spread would be, let me just get out my annotation tool. A spread is boom, boom, long a put and short a put, right? A call spread is long a call and short a call. And then straddles would be long a call, long a put, or short a call and short a put.
Yeah, so that's my question on straddles, which is like, how do I think about
Well, it's called a
the,
straddle because we're straddling the strike price line. That's why it's called straddle. So the straddle is on this at the strike price.
but straddles have two break evens,
They
right?
do, yeah. Oh, only ones with two break evens. Remember, we just did some of this yesterday. I thought you were okay on this, right? Boom, boom, boom. Here's
But
our
what
break
about
evens.
calculating max gain, max loss? I mean,
Yeah,
to your point, it's within the strike.
yeah, it's gonna be two. So here's our break even, right? Here's our straddle. There's what it looks like. Boom, 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 boom. Oh, come on. Baby. So there's our straddle, boom. And let me get to the one though that we have in the book. We did these, a couple of these yesterday. Boom, boom, boom. So let's find it here. So we're straddling the strike price line, which is two, boom. That's what that looks like, right? There's a long straddle, there's a short straddle, right? And the market price can go everywhere. So the break even is going to be total premiums 4 and 3.
Mm-hmm.
So the upside break even here is 47. The downside break even is 33. Let's
Wait,
give you one to
sorry,
try.
sorry.
Did we do any of these practice questions before on this kind of stuff or not? And
No.
okay, well, let's try one. So here we go. Here's one for you to try. We'll have you demonstrate your prowess or lack thereof. Boom, boom, boom. Here we go. If a customer buys 5 ABC September 50 calls at 5, and 5 ABC September 50 puts at 3, this position is called.
Okay, so just to talk this out loud, this is a straddle. It is you're paying more than your
Well, not more. It's buy. You're trying to net things. Nets are spreads.
oh yeah, sorry.
That's
Buy,
okay.
buy. Yeah.
So you're out of pocket
So you're out of
5 and
pocket eight.
3. So your break evens are
58 and 42.
right on. Where do you want the market price to be in relationship to those two break evens? Do you want it above 58 and below 42 outside, or do you want it in between? Do you want the stock in between 48, 50 and 42?
You want it outside
Right on. And then why are you doing this? So 4 test questions.
because
So
you
far you
expect
give me 3.
volatility.
That's right. Yeah. That's 4 questions, right?
So, but the one question you didn't ask me is
I
like
asked you to
max.
identify it. You told me it's a straddle. I asked you to calculate the break evens, which you did. I asked you where is it profitable, and I asked you when to use it. Those are the 4 questions on straddles.
But what about max gain, max loss on this?
Oh, well, max gain. Yeah, I didn't ask you that, but will you tell me max gain?
I mean, well, max gain is actually infinity.
Yeah. Don't overthink it. Don't say, well, the put the call. No, it's unlimited. Right. Okay. So, and then what's max loss? You shouldn't be struggling with that when you buy options. What's the worst case?
Premium.
Yeah.
Lose
I
a
say,
premium.
Brian, is that $800 you can afford to lose?
Yeah.
Right? I mean,
Okay,
it
got
doesn't
it.
qualify somebody who wants to buy options. I joke, Brian, I was teaching a Vanguard class and they have a smoking area. And I was smoking a cigar and these mover guys were, blue collar guys. I got another, I like blue collar guys. I'm certainly not a blue collar guy. So, I'm pretending I'm a blue collar guy. I'm out there smoking with them. And, they were smoking cigarettes. The guy was telling me that he buys like $400 a week in lottery tickets. And I was thinking, man, I don't know what movers in North Carolina make, but I felt like saying, gee, do you realize what that would do, call it dollar cost averaging for you? I mean, I guess there's no suitability. If I worked at
Yeah,
the convenience store, I might say, listen, is this money you can afford to lose
that's
for everybody? It's a
crazy.
different number, right? But when you're buying options, it's pretty easy to qualify somebody who wants to buy an option position. Is this your play money? Is this your speculative money? And we were joking that you were talking about your old wife, Brian. I had a guy. I may have told you the story. If I tell you the same story, just let me know. But anyways, we did a stock an option trade where we made it was like $13,000-$20,000, and then he was doing it had a lot of risk, but it was my idea solicited, and then he did his idea, and it was very similar, but I couldn't get him to do the credit spread. So what he did, it was the naked option and not the credit spread. I said, why don't you put in a floor there? Anyways, it blew up on him, and he had $100,000 loss. And I thought it was so funny because he pretended to be a big boy and like, oh, Dean, 100 grand, I can use the loss against my tax return. And I said, geez, in my world, I'd be a little more uptight about that if it was me, and I thought, well, okay, God, I shouldn't be prejudicial about other people's lives, until I went over to go to his house for dinner. He goes, hey, Dean, don't bring up that $100,000 loss with my wife. It's not a good topic of dinner discussion. I go, not quite the big boy you claim to be.
Put that on the DL, on the down low.
So, who knows what the number is, right? Who knows what the number is?
Oh, that's too funny.
Yeah.
Oh my God.
All right. Anything else for tonight?
The last question just broadly is,
Yeah.
this is something, remember when I was like freaking out doing options with you the other day?
I'm just more worried about you freaking out than anything. I mean, all those scores are great. And
But
you,
the
you
thing,
have a brain that's capable of, being outsmarting yourself. So please don't do that Tuesday.
okay. But the reason I realized this when I was going to bed the other night, the reason I was stressed is because Notman's been great. Their videos are awesome. But like the one thing about Notman I really don't like is their sort of accounting nomenclature for options.
Oh my
And
God. So I listen, what's the guy's Muskoff or whatever? I love them
yeah,
too. They're great people, but every once in a while they hinted like,
like first
if you want to get
position,
back in the
second
real world and have a
position,
real
like
job kind of work for us, I go, you guys are too straight laced. Yeah, the straddles, they run the legs separately and then they net them, which I just
yes. And so like that, I wish someone just threw a whole bucket of water in my face and be like, stop. Like just come up with something like this because intuitively you can talk it through. So my question is like, when you're doing the T charts,
yeah.
are you just replicating this?
I am, except I'm just doing both legs at the same time. So for example, let me just show you one. Here's one right here, right? So what I'm doing on that, let me show you real quick. So I'm running the legs. Boom. Hold on just a sec here. I told you the people at Zoom have changed their toolbar on me. Okay, boom. So, and I showed you, I think in one of our sessions, their method. So their method is to put both legs down here and then run them separately and then net, right? So what I do is
I don't like doing that. It like fucks me up.
I think, in their defense, I think they've made a decision that some people will never figure out the other way, maybe. And so they're trying to get as many people on board as possible. And I certainly understand that.
But can I just like, sorry to interrupt, but like when I see this, like my brain, the way I'm programmed, I immediately say, what is this? Identify it. And it's
that was what I think you should do.
Call
so
spread,
here,
right?
Yeah, that's exactly. So we got 6 and 2. So the Notman version is what? Let me just fix that real quick. The Notman version of this, it's like their balance sheet. Marshall loves that thing. She's the one over there who is convinced that's the best way to teach margin. Again, their heart's in the right spot. But they do this. They do like we open this for 6, and then we do this one for out 2, and then they have you close this thing out. And I don't do that separately.
I can't think like that. Like I look at this.
So I close it out right here. Right? I don't close it out with a separate line. I just do my offsets. Remember, because the whole point of the offset is this is going this way and this is going this way. So
right. So like I look at this.
In my case, it's going to look like this. I'm going to close it out, and maybe this is now 3, and this is 1. And in Notman's version of this would be another column down here, and we would have plus, minus 1, and we would have plus. No, we would have, excuse me, we'd have, minus 1, and then we would have plus 3. And then they would say, now the difference in the premiums was 4, and now the difference is 3, and they would net it each way, right? So then this company, they have a number down here, and then they have a number down there. I just net this. So with me, the way I do it is I just net these, right? And I go, okay, so I'm a happy guy.
Right. And I just look at this and I say, okay, it's a call spread. It's a credit call spread because you're getting
right. That's exactly right. Credit call spread.
It's
you want
a
the
credit call
contract
spread.
to expire so you can keep the money. You want the contracts to narrow.
You want to
Your max
narrow.
gain is the 4 points. Your max loss is the difference in the strikes less the 4, 6 points. Your break even is 44. Call that to the lower. And your bearish, larger premium dominates. Yeah, that's it. That's what you got to be able to do.
Okay.
So,
Got it. Can you
right.
just put did the chart back on here? You said don't fall because you have to multiply by 2. What's the original table you had in the bottom?
Yeah. So once you're all done, then you just got to remember you got 2 contracts there. So in our example, we said the max gain is 4 points, but there's 2 contracts there. So that's
Right, so
going
it's
to be
8.
11 points. Right. Break even is expressed though per share. So we talked about that earlier, right? So the break even here is 44.
Oh, good to know. Okay,
There's 2 contracts, right?
yeah, because that doesn't affect the
Yeah,
strike
doesn't affect the
price.
break even.
Hold on, let me just make sure I understand this. Net premium, yeah, 4.
Yeah.
Lowest strike price, right? But
Yeah,
why are you saying
you should be able to look, you
don't
should be able
fall
to
for
look
the
at
trick?
yeah, well, here's right. So here's the dominant leg. It's always the one with the larger premium. Lower, remember, lower strike calls always have greater premiums. All the action takes place between the strikes. All the action is between the floor and the ceiling here. There's 10 points to be made or lost. Of the 10 points to be made or lost, you collected 4. So you can make 6. Or excuse me, lose 6. You can make 4 and lose 6. Right? We know the break even's right there in between those 2 numbers, right? So
But why are you saying don't fall for the trick? Because people would multiply 2 times 44?
yeah. Look, see, they did this here for you. They gave you a choice of 88. Right.
Got it.
So yeah, it's a per share number. Break even.
I may have fallen for that. So
No, you break even's always expressed per share. I say
but
at
what about the
$44, Brian, we break even because at 44, if we have to buy the stock at 40 and deliver
right?
at 44, we lose 4, we got 4, we break even. Right. The other
Right, you're
reason,
not going to mess around with the strike price. The strike price is the strike price.
yeah, but the other thing, that again, the reason I also like the T, you're going Tuesdays, you got to be a little careful about, what you're going to continue to do. I think you should go with what, is working for you. But again, let me show this to you real quick. The other reason I like the T is because if I get stuck, I can say, okay, boom. Assume I got the T set up. I got my 6. I got my 2. And I know the dominant leg is my obligation to sell the stock at 40. And I just think that makes my life easier now because now if I need to, I can kind of fumble my way through what that break even is, which is 44. Right? Because that's what make the columns balance. So where'd I get this? This is the 2 we spent. That's the 2 we collected. The 40 is our obligation to sell the dominant leg. And now I can know the break even is 44. And I know 46 would be bad because that goes upside down on me. I know that 42 is good. So I just think the T is a better way to go. But, there's lots of ways to do options and math. So
Got it. Okay. Good stuff.
All right. So I'll be with you in spirit. I'm going to teach till 4 o'clock. But if you just need a rah, I don't want you going down any rabbit holes. But if you need a rah, we'll just reach out and I'm more than happy.
Do you honestly think I'm ready for this?
I do. If I didn't, I wouldn't send you down there. I mean, listen, if you don't make this thing on Tuesday, it's going to be on you and it's going to be you outsmarting yourself. It's not going to be the exam. It's
Right.
going to be, so, well, yeah, I don't know. If I didn't think you have enough base knowledge, Brian, I wouldn't send you down there. So
Okay.
I think the scores reflect me talking to you. I think, like I say, you know more than the average bear, so to speak. Most of the people taking the test, but that makes your life a little more miserable, I think.
Right.
So I mean, it's like I said, it's better to have too much brain power, except don't use it against yourself, right? So
How much time am I I mean, they say like a Notman, like some of the practice exams I can plow through. It's not a race, but
no, you should have a
you
time
also don't
constraint.
want to be taking your sweet time.
No, you should have a time constraint. You might run out of right answers, but you ain't gonna run out of time. I mean, have you been
Right.
timing yourself?
Yeah, I'm in comfortably inside it, but like,
Okay.
do I utilize that and like move my legs, get a glass of water, and
I
go to the
would, I
bathroom?
would,
Like,
I would
right,
everybody's rhythm's a little different, but boy, I just tell you, most people aren't wired for, that length of time with sustained concentration. So whether it's half or every a third, I would break it up in my own mind. And if that means go and get a glass of water or whatever,
And they're okay if you do that?
What's that? Yeah, well, yeah, you gotta use the restroom. Don't give them any reason to think you're doing anything nefarious out there. But yeah,
Right.
stretch your legs, take a walk, or whatever. Just even a mental trip at your station where you're at. I'm a big believer in that. And
Okay.
then, like I say, just don't stick with your gut. And like
Don't
I say,
change
your
answers.
tutor thinks you know enough to pass. And I think you're gonna be fine. I really do. Um,
Okay.
there's, like I say, execute your study plan and just demonstrate what you know. I still think with those scores, you remember, don't turn anything into a make or break question because it's not. I do think you're operating from abundance. And so what I mean by that is I don't think any 1, 2, 3, 4 questions is going to be make the difference. I think
Right.
what make the difference is if all of a sudden you fall off the tracks. you know?
Right.
So, but I don't see that happening. I'm just saying, I don't want you spending more time than necessary on questions. I mean, aim and shoot, point and click, and move on.
Okay.
All right.
Sounds good. And I'll get some rest.
Okay. Yeah. I get some rest, and then I think you said you don't have to work tomorrow either. Just as your full day.
Right. So what do you do tomorrow? Just keep taking practice.
Yeah, I want you to be careful. I mean, you're a hard worker, and I don't want you to wear yourself out tomorrow. So the main thing is just make sure that you're not working too hard. You mean if you want, you can do another practice exam in the morning,
Okay.
get a score, and just verify you're in the 70 and remediate that one if you want. Remediate the ones you got wrong.
Okay.
Review your notes. I think your low-key needs go over if there's any slides you haven't gone over, go over those. So
Okay.
yeah, I think you're in pretty good shape. So I would probably put it up about early afternoon. I'd be done. If not,
You would.
just whatever you do to relax. I like to have a nice scotch and a cigar, but maybe a glass of wine, or if you got a boat that came with the house, I don't know, go out fishing, whatever that kind of puts you in the right frame of mind for Tuesday. What time Tuesday? Morning, afternoon?
It's like 12:15, but by the
Okay.
time you check in and stuff, you usually start early. So
And you did the SIE already, right?
yeah.
So, and what'd you think of that? I mean, was that a victory and you knew it was a victory, or were you worried about it, or?
Honestly, I shouldn't tell you this. It was just a weird experience.
Okay.
Like, I think I got the experimental questions all at the beginning. I honestly thought I was taking like the MCAT or something. Like,
Okay.
there was one question that had nothing to do with anything in finance. And then there was like a normal question. And then the next question was just, it wasn't even a fake out. It was just like an obscure,
well, it's the same thing too. I call it the draw can be different. So make sure you stay in the game. So even if you start out Tuesday, you're like, oh my God,
right.
just stick with it because
Because there's 10 experimentals.
What's that?
There's 10 questions that don't count.
That's right. Experimental questions. I call them outer space questions. So,
So even if you get it right, it doesn't help you.
Yeah, it doesn't help you. It doesn't hurt you. What they do is they're testing them for validity. So every once in a while, somebody will tell me that, they saw a particular question. I won't tell people about it because if people can't get it right, it disappears. If it's an easy one, I say, yeah, but make sure you get this one because then it'll stay in the data bank, right? The Q bank. So,
right.
So,
okay.
Yeah, but I think you're in good shape. So, all right, I'll be expecting to hear from good news. If I don't hear from you before Tuesday, I'll expect to hear some good news Tuesday.
All right. Thanks, Dean.
All right.
Say a prayer.
And I'm here. If you, like I say, you don't need book tutoring. If you need a raw tomorrow night, just, let me know. And but again, first do no harm. So, Hippocratic oath, it was as we're saying, you just need to stick the landing. So we don't want to do anything that's going to cause you to get out of the flight pattern.
Yeah, I hear you. I hear you.
Okay. All right.
Thank you, Dean. And seriously,
my pleasure. My pleasure. I'm looking forward to getting the you made your mark on. And then you can just forget all this short sales and options unless you want to go open a brokerage account and start messing around, right?
Right. But please send Jenna a bill for like 2 hours. I mean it. You've been
no worries. What I'll do is I'll just change the sessions from an hour to 90 minutes. It's easy peasy.
Okay, cool.
So that I think we were a little over tonight, a little over the other day. So no worries.
I really appreciate it. Thank you, Dean.
And for some reason, I don't know why. Maybe it's right, Jenna. You guys are the only ones I've ever had who didn't get links. I don't know if it's a firewall at TPG or whatever, but
it very well could be.
Honestly. It makes me nervous because boy, if I have to start sending everybody links, I'm gonna have to hire somebody. I'm gonna have to hire my own Jenna.
Exactly.
Okay, my friend. See you later. Bye-bye.
Thanks, Dean. Bye.